Welcome, everyone. Thank you for being here today. It looks like a lot of folks are still joining us from the waiting room, so I'll give it just a minute while everybody is being led into the presentation. Thank you all for being here today. We'll kick off in just a minute. All right, so I think we'll go ahead and get started. Thank you everyone so much for being here today. We really appreciate having you join us for today's session of Maximizing Your Charitable Dollars, Tax-Advantaged Ways to Give. We so appreciate Wolfpack Women and Philanthropy for sponsoring this session in partnership with the NC State Alumni Association. Really appreciate the opportunity to be here with everyone. My name is Katherine Miller. I am the Director of Gift Planning at NC State. As part of the Office of Gift Planning, I have the opportunity to work with our wonderful donors that are considering estate gifts to university and tax-advantaged gifts, which is what we're talking about here today. My colleague, Devan Colbreth, is also joining me here today. Devan is our Associate Director of Gift Planning. I'm very lucky to have her experience and background with us, and she will be assisting today, answering questions live in the Q&A box and the chat box as I'm doing the presentation. So as you have questions, please feel free to go ahead and submit those, and we'll answer as many as we can in real time. For anyone who affiliates their name with the question, so there's an option to submit anonymously. If you don't do that and we know who asked the question, if we don't get to it today, we will follow up with you. But feel free to submit those questions in whatever manner you're comfortable with. And of course, we'll be answering questions live throughout the session, but once the presentation concludes, I will take as many questions then as time permits as well. Ellen, did you want to say anything before we kick off, or are we good to go?
Yeah, hey, thank you, Katherine. I appreciate the chance to just say welcome to everybody. My name is Ellen Richardson from the NC State Alumni Association. And thank you to you for taking your time today to share your knowledge with us on this topic. We will be sending out this recording after the fact to everyone that pre-registered, and we will also be posting it on the Alumni Association's YouTube channel. So you'll have access to it that way as well if you'd like to share it with anybody after we conclude here today. Thank you to you and Devan for your time, and we really appreciate the partnership.
Thank you so much. All right, well, with that, we will kick off and get started here. My slide to change, there we go. Okay, so today's objective is to introduce everyone to some different tax-advantaged charitable giving vehicles. My goal is to have you be able to determine which vehicles may be available to you in your personal situation, to spend a little time assessing the benefits and considerations related to each vehicle, and leave here a little bit more prepared to be able to discuss the applicable options with your family and trusted advisors. So before we dive into the material, I have to give our official disclaimer that we always share, that to please not consider anything you hear today as official tax or legal advice for your personal situation. We can only discuss what we have seen in our experience as gift planners here at NC State, what has been helpful to many donors and what we see as popular options. But we know that everyone's personal circumstances are different and their finances are different and how that may impact your situation. So we really encourage you to speak with your professional advisors about that. All right. So for our agenda, today we're going to walk through a few different tax-advantaged vehicle types. So there's tax-advantaged gifts that can be made outright, a couple of those that we'll cover. Some tax-advantaged gifts that we refer to as life income gifts, which is another category that we'll discuss. And I'll wrap up by sharing some information about some special charitable provisions that are in place just for 2021. So as we approach year end, hopefully maybe some helpful information there. So there's a few categories of outright gifts that are tax advantaged that I'd like to share a little information with you all about. So as many of you know, if you itemize your deductions, any gift that you make, cash gift, write a check at year end, you put that credit card information in for a charitable contribution, that has a tax benefit. If you itemize your deductions, you are able to claim that charitable deduction and reduce your taxes accordingly. The difference between that type of cash gift and these, what I refer to as tax advantage gifts we're discussing today, is that these particular giving vehicles confer some additional tax benefit over and above what you would get with a cash gift. So with a cash gift, you're taking your hard-earned cash that you have already paid all your taxes on and come out with a little bit less than you started with, and then you're giving away those tax reduced dollars for some tax benefit today. The vehicles we're going to talk about, you are actually able to have not only a charitable deduction associated with them, but some tax savings as well. They don't trim away those dollars quite like the cash. So the first one we'll cover is appreciated long-term stocks and securities. If you have held stocks long-term, which is typically over a year, and you have experienced some appreciation in value, you probably know that if you go to sell those stocks, you are going to have to pay capital gains taxes, and that will reduce the proceeds that you would get from that sale. If you instead choose to gift those securities directly to charity, rather than selling it yourself, paying tax and donating the proceeds, you are able to both take a charitable deduction at the current appreciated fair market value of the gift, but you are also able to avoid ever recognizing that capital gain and paying the associated tax on that appreciated value. I know this is something folks hear about pretty frequently, the benefit of gifting stock, and I think sometimes it can be hard to wrap your mind around that concept, but it's pretty straightforward, I think, if we look at it with an example. So I have an illustration I'd like to share here with you. So you'll see here, we have our, just for easy number example, a stock that you purchased at $1,000 way back when. You've been holding it for a long time, and it's now worth $10,000, which is just fantastic. You've had some great gains, but you know that if you go to sell that stock, that's $9,000 of gain that you're going to have to recognize on your tax return, pay that capital gains tax and reduce, you're not going to end up with $10,000 after that. So what you could do is you can take the route of selling it, monetizing your $10,000 and then paying the associated capital gains, which could be anywhere from 15, 20, or even 23.8%. That's just the federal capital gains tax. That does not take into consideration any state tax that you may owe. Some people may be thinking, I think I heard that, some capital gains you don't have to pay tax on, and that's true for certain income thresholds, but the 0% tax bracket typically only applies for income of about $40,000 or less if you're single, or a little bit over $80,000 for couples that are married filing jointly. So once your income creeps over that, you're starting to look at these 15, 20, 23.8% rates plus state taxes. And as you can see in the picture, that's going to reduce your little cash pile quite a bit. So an alternative, if you're looking to make a charitable gift anyway, instead of funding it with cash, would be to fund it with the security itself. If you transfer those stock shares directly to NC State, it's a very easy process. Most brokers can do it electronically. We or any other charity are able to sell that for the current fair market value. And because we're charity, we don't pay any capital gains taxes. We get to keep the whole $10,000 and put that straight to work for whatever charitable purpose you have designated. You are then able to deduct the current fair market value, in this example, $10,000, even though your basis in that gift was only $1,000 and you never paid tax or recognize the gain on that appreciated value, the IRS still permits you to deduct the full value of that asset, which is a really wonderful benefit that the tax code permits. And that is why this is considered such a tax advantage way to give. So hopefully that illustration was helpful. Sometimes after we talk about gifts of appreciated stock, folks say, well, that's great. You know, I really would like to experience those benefits rather than just giving cash. But, you know, I like my portfolio. I've got some stocks that, you know, have done really well, but I think they're going to keep being winners. And I don't want to take them out of my portfolio. So I'm just going to cut you a check instead. I don't really want to lose those shares. So one consideration I would encourage you to think about would be to still take advantage of this method instead of just writing that check anyway and keeping the shares in your account. You could consider locking in that appreciated value by going ahead and gifting the appreciated shares, taking these tax benefits, and instead using the cash that you were prepared to send to charity to repurchase replacement shares of those same stocks that now will have a higher cost basis in your portfolio. So in the future, at whatever time you are ready to sell those, you would have less gain to recognize or the ability to recognize a loss should, you know, the market turn and those shares not perform as well as you'd hoped. So that is oftentimes something that if you are looking at outlaying cash anyway because you like the shares you're holding, that can be a nice way to lock in some of that appreciated value benefit while keeping your portfolio, you know, organized in the same manner. I have laid out that illustration here as well for you. So you'll see the same example, purchase price 1,000, value 10. So again, that $9,000 gain, if you were to transfer it to NC State, instead of writing the check for $10,000 that you were prepared to do because you liked that stock, you instead are able to deduct the $10,000. We have the full value to put towards your gift. Nothing's lost to taxes, and you have stepped up the basis in your portfolio, which can have a lot of benefits for you in the future. So the next category we'll discuss here is appreciated long-term real estate. The great thing about this category is it's very simple because it is exactly what we just walked through with appreciated stock and securities. The tax benefits are pretty much exactly the same. So you have property. Think about vacation property, rental property, perhaps inherited property that you've inherited from like family, real estate that you're no longer interested in holding on to for whatever reason. You have experienced appreciation in the value of that property over the years. So instead of selling that property, and again, recognizing what could be a large, value of capital gains and paying the taxes on that, some folks instead choose to gift that real estate. They actually deed over the property itself. And tax-wise, it works in much the same manner. The donor is eligible for a charitable deduction of the fair market value of the real estate. So not the basis, but the current value today, and they avoid the capital gains tax on that appreciated value. So that can be a great benefit really to make some powerful charitable impacts. The one kind of caveat there is, of course, unlike with stock, with real estate, there's no easy determination of fair market value. We can't look at the stock market on the day that you gifted it to determine what that real estate was worth. So the IRS does require, in order to take that charitable deduction, that you obtain a qualified appraisal. And that qualified appraisal is how you would determine what is the official fair market value of that gift. We here at NC State do take gifts of real estate. We have a wonderful team in our real estate office that works with local brokers in the area to market and sell properties that are gifted to us and put those proceed dollars to work in great charitable ways. We have a due diligence process we go through that typically takes just a couple of weeks with the real estate team before we would officially accept title to a deed of real estate, of course, but it's a surprisingly quick process, I think, and that has been a great way to fund some gifts I've had the opportunity to work on in the past. For those of you that are over age 70 and a half, you have the opportunity to make some charitable impact using your traditional IRA account. So as you probably know, every year, many years, you have a required minimum distribution. They've changed the rules recently, so now you're eligible to do this at 70 and a half. Your required minimum distribution does not kick in, I believe, now until age 72. So they've kind of split the difference there. But you are able to request your IRA custodian to make a direct transfer from your IRA to charity up to $100,000 a year. So whatever amount you desire, it's pretty generous, the sums that you can go up to that amount. And by transferring those funds directly to charity, that distribution from your IRA is considered tax-free. It is not included in your taxable income the way that a traditional distribution would be. And for those of you that do have a required minimum distribution, any amounts transferred to charity under this QCD method does count towards satisfying that requirement, even though it is a tax-free distribution. So for those of you that are required to take distributions that kick up your taxable income for the year, it's a great way to not only support your favorite charity, but also reduce what otherwise is mandatory income for you during that tax year. Typically, these IRA QCD transfers are a very quick an easy process, but we always recommend that you request that by early December if possible. There's traditionally a huge crush of requests at year end because folks realize what a great way it is to support charity and finish that minimum requirement for the year. And so the IRA custodians can get a little bit overwhelmed once we hit mid-December with trying to process those. And another great benefit of this QCD method is that it provides a tax benefit whether or not you itemize. So we know that typically like 90% of taxpayers roughly don't itemize. So for anybody who's not itemizing, charitable contributions may not be a benefit, but because the IRA QCD method, it doesn't provide a deduction. What it does is it actually reduces your taxable income. It takes income that otherwise would be considered taxable and it makes it non-taxable. So it actually reduces the income instead of creating a deduction so that all taxpayers are able to benefit from that method. The last vehicle in this outright gift category that I wanted to discuss today is a donor advised fund. And then for folks that have a donor advised fund, it's making grants from that, so DAF grants. So when you think about funding a donor advised fund, those have become extremely popular vehicles over the last number of years. You typically are able to fund them through your local community foundations. A lot of the large brokerage houses, think the Fidelity, Schwab, Vanguard type institutions often offer donor advised fund programs. We at NC State even have a donor advised fund program as well. It's become, like I said, a really, really popular vehicle because what it enables you to do is to make a gift today of cash or stock, receive your associated charitable deduction, but defer your giving decision until later in the year or next year, a couple years after, whenever you're ready to make those grant recommendations. So you receive your deduction when the dollars go into the fund, but then the fund then holds the dollars. They can be invested. Oftentimes you would choose investments if you want, and then you make grant recommendations out of that periodically. So we often see those as very popular vehicles for folks having significant income events, sale of a business, significant sale of property, other things that are driving up their income for the year. Typically, when you're in a situation like that, you're also extremely busy with whatever event is triggering that income and may not have time to figure out, what your philanthropic goals are and what you'd like to support with those charitable dollars. But you want to match your charitable deduction to the year that you have all of this income because of this event. So donor advised fund allows you to go ahead and tuck that money away, designate it for charity, take your tax deduction, get through that really busy time in your life, and then circle back and start making those grant recommendations out of the fund. This also became an extremely popular vehicle after the change in the tax law a few years back, when the standard deduction was increased, and we saw many fewer folks itemizing. So folks that used to benefit from their year-end gifts to charities, perhaps we're not seeing that benefit because they're moved into the standard deduction category. So the opportunity to bunch their gifts, what they would do is they would pre-fund a couple years worth of annual gifts to their charities into a donor advised fund in 1 year to get them over the standard deduction threshold into itemizing, deduct all of those gifts in 1 year, but then they would then spread out the actual distribution of those gifts to match their normal annual giving timeline. So for a number of reasons, these have become very, very popular vehicles. I think I mentioned that those typically can be funded in addition to cash with appreciated securities. So that's a great way to combine the benefits of both of those vehicles. And I'll just say a few words on the NC State Donor Advised Giving Fund. You may or may not have heard that NC State launched its own donor advised fund a few years back. Very, very similar to what you'll find with a lot of the institutional donor advised fund programs. Our account minimum is $10,000 for funding. Obviously, once grants start going out, we know that that will fall below that dollar value. You can continue to make contributions to that account for as little as $250 at a time. Grant recommendations as low as $50, so a great way to fulfill those annual gifts you may be making at year end. We do use an easy online portal, and because it is the NC State Donor Advised Giving Fund, we do require that at least 50% of all contributions eventually be directed somewhere at NC State, but both the area of support at NC State and the timing of that are completely at your discretion. And that is easily tracked through the portal as to what those amounts would be. So the next category we were going to cover is of tax-advantaged gifts is those life income gifts that I mentioned. Two different types I wanted to cover here today are the charitable gift annuity and the charitable remainder trust. So the charitable gift annuity is a pretty popular vehicle. It has a number of benefits. So when you fund a charitable gift annuity, you transfer funds today, and in return, you receive a current tax deduction in the year that the annuity is funded. You receive income back for the remainder of your lifetime. And you also are able to leave a future charitable gift all in one vehicle. So pretty neat. There are, with most annuity programs, there are a variety of options to fit your needs for timing with respect to payments. Annuities can be done as current annuities, which begin payments immediately. That's definitely the most popular option. But we also see folks that are interested in deferred annuities, where the transfer is made today. Those same benefits, tax deduction today, but the payments are deferred for a determined period of time and begin at a later date, typically with a higher payment rate because of the deferral. And that can be a very attractive option for folks who in their later working years may be looking to receive some tax deductions while they have higher income to offset it against. But because they're still working, they don't necessarily want to receive payments today that they're just going to then be taxed on. So they'll say, well, it would be great if those payments could start when I'm retired. Wouldn't that be fantastic? And so they'll set that deferral for when they anticipate retiring and begin receiving payments at a higher rate at that time. So that's one nice alternative there. Gift annuities are a great way to diversify your portfolio in a tax efficient manner. Annuities can be funded with cash, but they can also be funded typically with appreciated stock. So, and the nice thing about that is when you transfer appreciated stock or securities to fund a gift annuity, instead of having to pay the capital gains tax on that, right, if you had sold it yourself, if it's sold as part of these annuity contracts, although the IRS doesn't allow it to be completely tax-free, because of course they are income generating and money is coming back to you, what they do allow is for that capital gains portion to be deferred and paid out in really small increments over your entire lifetime. So every year, a portion of your payments is typically tax-free, a portion of it is taxable, and of that taxable portion, some of it is taxed at the more favorable capital gains rate as you continue to recognize that in really small increments over the course of your lifetime. So it's a great way to take perhaps some stock that is really appreciated and be able to get that value out of that in some ongoing payments back to you without having to recognize all that gain up front. Funding charitable gift annuity is a surprisingly quick and easy process for the most part. It's typically a very short, straightforward contract, so it can be executed fairly quickly, which means to say there's still time before year end to get one of those done. And many charities offer, annuity programs here at NC State. And in most cases, the payment rate is based on the age of the income recipient, who we refer to as the beneficiary. At NC State, we do follow the recommended rates published by the American Council on Gift Annuities. We require that a beneficiary be at least age 50 in order to begin receiving payments currently for the remainder of their lifetime. Although we will offer a deferred annuity program at a lower age, as low as age 40, with a deferral until at least age 55. We offer joint life annuities for spouses, and we have illustrations available that would show, the tax benefits, tax deductions, and what those payment streams might look like. The charitable remainder trust, much like the stock and real estate situation where I said it's really the same and just a couple tweaks, that's the same here. So a charitable remainder trust is structured much in the same way as a gift annuity is. You fund it today and receive a current tax deduction. There are income payments back for your lifetime and a charitable gift at the end. All in one vehicle. However, a charitable remainder trust is a little bit more complex of a vehicle than a gift annuity. And because of that, it does allow a little more flexibility than a gift annuity. But on the flip side of that is because it is a little more complex, it does require an attorney to draft the trust document. And it does have some ongoing administrative costs that you don't typically see with annuities. So they are great for folks that need that additional flexibility. But in most cases, a charitable gift annuity is more than sufficient to meet what most people are looking for. And therefore you can avoid the trip to the attorney and those ongoing administrative costs if the CGA will suit just fine. Some reasons you might consider the charitable remainder trust instead would be, for example, you can fund a charitable remainder trust with real estate, whereas typically most charities wouldn't accept that for a gift annuity. Additionally, if for whatever reason, instead of receiving payments for life, you wanted it to be a term of years, charitable remainder trusts can be set for a term of years instead of a lifetime. And they also allow for multiple beneficiaries, whereas gift annuities max out at 2. So it can be a joint annuity, but just 2 joint people, no more than that. So charitable remainder trusts can have more beneficiaries than that. With a charitable remainder trust, the payment rate is not based on your age as it is with an annuity. It's a pre-selected rate that's determined within an allowable range. Most charitable remainder trusts that we see here at NC State use a 5% payout rate. Because they are a little more of a complex vehicle, whereas a charitable gift annuity here at NC State can be funded for as little as $10,000 for the annuity, we strongly recommend that charitable remainder trusts that you would look at a minimum gift of $100,000 to make those ongoing administrative costs and the startup fees with the attorney to make that make sense. So again, unless the complexity is called for because of the specific situation, typically the annuity is going to be the vehicle of choice for most folks. All right, and now we have made our way to the special charitable provisions for 2021. So some of you all may recall that what feels like a lifetime ago, back in March of 2020, Congress passed the CARES Act. That was the Coronavirus Aid, Relief, and Economic Security Act in March of 2020. And that act contains some special charitable provisions that at the time were only enacted for tax year 2020. But in the end of 2020, in December of 2020, Congress passed the Taxpayer Certainty and Disaster Tax Relief Act, which then extended these special provisions through 2021. We do think that was a final extension. There is not a general sense, I think, that those provisions are likely to go beyond 2021. They were targeted specifically at COVID relief. And so it is something that most people are expecting to kind of terminate this year when it expires on December 31st. But what they did is, knowing that, as I mentioned, about 90% of taxpayers don't itemize, in order to encourage charitable deductions during these difficult times, what they did was allow a special provision for cash gifts to public charities. So no stock, unfortunately, no gifts to those donor advised funds, but just cash gifts to your local charities. They allow a special, what's called above the line deduction, which can be taken for folks who don't itemize. So even though you're not itemizing on your tax return, you can still take this charitable deduction. It was for $300 for a single taxpayer, married filing jointly. Initially for 2020, it was $300 as well. You may have been familiar with that if you filed that last year. That's considered to be a marriage penalty, that they did not double that for married couples. And so that was corrected in the December Act. So for 2021, married couples are eligible for up to $600 on a joint return for these cash gifts to public charities. We had some questions submitted ahead of this session. This is a great time to address a few of those. Someone had asked, is there a minimum to how much you must give before you get a tax benefit for it? And so, typically, setting these special provisions aside, typically the decision to itemize is based on whether all of your eligible deductions, so charitable contributions, mortgage interest, if you have state and local taxes that you would pay, both income tax and real estate taxes, up to the $10,000 limit for state and local taxes, whether together all of those contributions are more than your standard deduction. So I believe for 2021, that's about $12,550 for single taxpayers, $25,100 for married filing joint. So if all your deductions are more than that, that's when you start to see benefit for those additional charitable contributions, except for 2021, when you get this, the $300 or $600 benefit, even if you don't itemize and you fall below those deduction levels. Someone had also asked, what about giving on sites like GoFundMe, or I'm probably going to pronounce this wrong, but I think it was Patreon. So the GoFundMe is considered to be kind of a personal crowdfunding platform. Those are considered, from a tax perspective, those are typically considered to be gifts and not eligible for a tax deduction. The information I could find on Patreon appears to be a paid membership site. So again, not likely to be eligible for any sort of deduction. All right, for the itemizers out there, the 10% of the folks that are now itemizing using the higher deduction limits, there was also a special provision put in place in those CARES Relief Act and the December Act as well, to again benefit contributions for 2021, also in 2020. What it did was, for folks who are itemizing, the cash contribution limit was raised. So when you make charitable contributions and you itemize your deductions, the IRS puts a cap on it. And so they say whatever your income is for the year, typically 60% of your income is the maximum amount that you can deduct for charitable purposes before they force you to carry it forward and wait until next year to recognize some of that benefit. And what they did was they said, hey, for 2020, now extended to 2021, we're going to waive that. We really want to encourage charitable giving during this time. So you can deduct charitable contributions up to 100% of your income for the year. And so that was a really, really significant benefit that they have put in place. Again, to take advantage of this special provision, it is cash only for that 100% limitation that was raised. And it is for public charities only. So again, no donor advised funds for this specific provision. It is a taxpayer election that you must opt into, and combined limits do apply. So you, as you may know, I mentioned the 60% is typically your limitation for cash gifts. There's also a 30% limitation for gifts of appreciated assets like stock. So if you hit your 30% limitation for gifts of stock, what you're left with is 70% that you could then, of your income, that you could then gift in cash and deduct for 2021 without having to carry it forward. You can't add them together and gift 30% of your income in stock and another 100% in cash and get over that 100% mark. They figured that one out and said, no, combined limits apply. All right, so that was all that I had wanted to cover here today. So we've made good time on that. So I'm going to check in with Devan here and see if we have any questions to answer live.
Hi there. We're going to wait and see if we get a couple more live questions, but there was some confusion caused by me because I answered some questions that had not been shown to everyone. So we had one audience member ask whether or not there was a taxpayer AGI limit that restricts a QCD amount, and in a similar vein, whether or not your QCD can be greater than your RMD was eventually what I understood it to mean. And I responded, and I told everyone that on the feed that I would respond to them as well, that whatever your RMD is, you can give that much per year in a QCD. And if you wish to give more, you can do that, but it's not a rollover gift like it would be. But I'll let you further explain.
Yeah, so all taxpayers who are over 70 and a half and have an IRA, so anybody who's looking at the QCD mechanism is able to give up to $100,000 per year through that method. There is no AGI cutoff that I'm aware of there. What Devan was referring to is obviously the ability to count that towards your required minimum distribution requirement caps out at whatever your required distribution is. Unfortunately, you can't, if you're, let's say your RMD was $10,000 and you decided to gift 20 with a QCD, you have completely satisfied your RMD for 2021, which is fantastic. The whole 20,000 is tax-free, which is also fantastic. But you are not able to count that additional $10,000 towards next year's RMD. You're still going to have a new RMD that starts up next year. That is not a carry forward. But the whole $20,000 is tax-free. It's not recognized in income. So you certainly can give more through this mechanism than just your RMD amount for the year.
All righty. And the next question we had was whether or not the CGA minimum here at NC State was an annual minimum of $10,000. And I explained that it wasn't so much an annual minimum, but a per CGA minimum.
Yep, per contract. Yeah,
correct. So you could do multiple CGAs in a given year, but each time you did one, the minimum amount you would have to use would be $10,000.
Yeah, exactly. And so one reason for that might be because, of course, if rather than doing two $10,000 in 1 year, you could certainly just do one $20,000. But our CGA contracts are done, directly with one of our affiliated foundations. As some of you supporters of NC State may know, we have quite a number of different foundations. So, for example, if you are a supporter of, let's say, both engineering and the libraries, and you wanted to do a CGA to benefit each of those, you could do one $10,000 with engineering, where whatever remainder gift is left in the future after all of your lifetime payments have been made, once you pass away, whatever is left in that contract would benefit, in that case, engineering. You could set up a separate contract to benefit libraries or any other area of NC State. So that might be a reason to set up multiple contracts, would be to benefit different areas at NC State. But as Devan said, the minimum per contract is $10,000.
Alrighty, and that appears to be all of the questions that we have right this moment.
Okay. All right. Well, I'll hang out here for a few minutes in case anybody is just slow typing, and happy to get to those questions. But otherwise feel free to disconnect if you are in a rush off to your next thing. Thank you so much for taking the time to be here today. We really, really appreciate you joining us. We hope it was helpful information. Please feel free to reach out and have a great day.
Oh dear. Catherine,
Mhm.
we just, as in seconds ago, got an anonymous question. Did you see it?
I did. I just saw that pop through. So,
Okay.
so that question is, if I'm 40 and a parent who has my kids' college payments coming up in the next 15 to 20 years, what would be the most strategic big picture steps to take to plan for giving down the road? Gosh, that's a great question. Let me let me think about that here. To plan for giving, so I'm assuming that the person asking the question is talking about charitable gifts down the road. I'm not sure if they're thinking after 15 to 20 years, once the college payments are done. I mean, certainly donor advised funds are a great way to, tuck away amounts to kind of build up to a larger gift that you'd like to make in the future. Let's see, strategic big picture steps. Van, do you have any thoughts there?
No, I suppose that the thing to think about would be that any of your charitable gifts or big picture, I mean, any kind of charitable giving that you did would be to offset any taxes that were accrued. So that's not really something that relates to having to sock away funds so that you can pay for your kids' tuition. But at the same time, I would think that using some of the state funded vehicles for saving for children's education, I mean, those you could have used, I believe, a 503. But anyway, I believe you could use those from when they were children, and that's all I can think of.
Mm-hmm. Yeah. Okay, I'm just looking through the chat here to see if any additional questions came through. It looks like, yes, someone asked about the video being available. The recording is going to be sent out to all registrants. Someone just asked about, did we cover opportunities for endowed scholarships or capital contributions that might include naming rights? So no, we did not cover that specifically, but happy to speak to that a little bit. So endowed scholarships at NC State, undergraduate named scholarships begin at $50,000 currently, but they can be funded through any of the vehicles that I've just talked about. So transfers of appreciated stock, real estate, all those great mechanisms, in addition to, of course, just cash gifts, can be used to create those endowed scholarships. One thing I would point to that we did not cover here today, but can also be done to fund endowed scholarships, is gifts through your estate planning. So we did a session a few months back on some general planned giving opportunities, and I believe that session is available online. Also happy to speak with anyone directly that has particular questions, but certainly gifts can be made through your estate plan, for example, in a will or retirement account, as an alternative vehicle to fund an endowed scholarship at NC State. And of course, that would then be funded at the time the gift is realized in the future. Naming rights, I probably can't speak to in a general sense. Those are, of course, very, very specific to the particular gift being discussed. But certainly would be happy to speak with anyone directly. Yep, we will send out the slides as well. Somebody asked about that. The slides will go out with the recording. And I think that is all of the questions. Devan, have I missed anything?
If you missed it, I missed it.
Okay. All right. Well, in that case, I think we are going to wrap up here. Thank you everyone so much. As like I said, really appreciate your time. Thanks for joining. And please send us any questions. We're happy to speak with anyone directly. Thank you.
Bye.